Let's get into this. All right, folks, this is going to be a pretty quick one, but one that I'm taking essentially my midday break and going to have a live stream with you guys today because I'm going to be busy tonight and I want to make sure that I can have this discussion with you guys, as a lot of people have reached out on just their concerns with things that are coming up in the space and are just feeling disenchanted, as it were, as a miner. If you're a miner lately, you've felt kind of the pressure of what's going on with Ethereum, with the changes. What's it all mean? What does the not having access to GPUs and you're sitting on the sidelines and you're trying to get in? Like, what's going on? What's the space look like? Let's have that discussion today. I'm going to be going a lot of this through the model that I've been working on. We are trying to turn this into a website. It's still right now in a Google Sheet, which is still better than like an Excel sheet, so more people can interact with it. But we're trying to coalesce this information to give kind of a fuller scope of all the different types of algorithms that you can mine with your hardware, if you're a GPU miner, and kind of what happens with big changes like that are coming to ETH, and if it starts to affect effectively the calculus that you used yourself to figure out if you were going to be miner in this space or not. And I want to kind of go through some of those elements, what make up those calculations, what are the risks, to make sure any new folks that are on, if you find this video and you're new and you're not in the space yet, what are the things you should be considering right now? What's going on in the space right now that definitely would affect you directly, not so much indirectly. There's some direct things that are going to impact mining, and then there's some kind of indirect things when it comes to like price that we don't know what'll happen with price, things that happen with market ebb and flows. But the best thing we can do is take a viewpoint of like what are the real situations that are about to come up and how much does it really affect me in this space, especially if you're like an ETH miner. We'll let some folks get in here. What's going on, guys? There's a statement in there, GPU will never die. And the GPUs will always mine something out there forever. It's been that way since the beginning of time on mining, with Bitcoin through Litecoin, through effectively every currency that's been through the GPU ringer, as it were. There's always going to be, when there's force projection out there where people have access to onboard into a network, there's always going to be this facilitation, from the network to provide access to people, to be able to use their own hardware. I think that there's a known state that we have where we know millions of people will get together and participate in mining, which creates an entire other ecosystem of organic growth for coins. And it may front run initially to bootstrap a network, and then it takes on to the effect of like, what are the other secondary and tertiary effects of a network when it comes to the user base and that. And there's this symbiotic relationship that usually starts with a lot of new coins and its mining. It gets the excitement in there. People can mine and provide for that network. And then it kind of transitions sometimes into other things. But I'll let you guys joke. Big Joe, big supporter of the channel, $10 super chat. What's up, Carter? I just found some time to be able to talk through some of these bigger pressing issues right now in the mining space, and try to have a video that people can get pointed to if you have concerns, or if you're a miner or people that are mining and they have concerns, you guys can point them to this video to kind of just let's understand the scope of what's going on right now. So we got a few folks in here, got about 190 on there. We're going to go and just start kind of around the current situation right now in GPU mining. We have effectively a supply issue we've had for about 6 months now, 7 months. I think it really kind of started in October of last year, where we saw after the RTX series is coming out, a real big suppression of the amount of available GPUs worldwide. And it's been about 6 months. It's kind of affected the entire industry, not just for gaming, but for really everybody. Everybody's pretty much on borrowed time on their current existing GPUs just because the market has been so overwhelmed with the crypto success. And, we don't get real true supply numbers from NVIDIA and AMD to find out, what is this in relation to previous like Polaris launches with NVIDIA. I think there's some loose numbers out there, but there's not one trigger that I can go to and figure out like, okay, here's like a car maker would do with like a car production where they'll put out there, here's what we're going to build, here's our outflow. And they have that for investors and people to understand like kind of what their scope is for probably, I wouldn't call it selfish reasons, but for like just the companies making sure that from a competition standpoint, they don't have all that data. It's not readily available. So we don't know if some of this supply piece is COVID related, where there was some supply chain crunch. I think a lot of us have given the benefit of the doubt that that's probably the case in a lot of ways. Mixed with, the bull run out there. So there's still a supply issue. GPUs are now, almost 3 times MSRP. I'm going to be running out tomorrow morning, early, very, very early to get in line for the 6700. It might be where I go to bed early tonight and then wake up 2 a.m. and go out there to Micro Center to try to get in line to get the 6700. I do have a most recent build for the kids that I'm actually going to use that not just for mining. I will test it with mining, but it'll go into an actual new Ryzen 5600 build. But just the things we have to do to try to get a GPU these days are definitely a big issue. And when you're talking mining, you're talking about your entry price. I get a lot of questions with like just the hardware cycle and like, should you get in, what's the viability of it? When you're paying 3 times what the MSRP, the recommended prices, that's industry establishes, hey, this is a fair market price predicated on, them making some money, the wholesaler making some money. There's a price establishment. When you're building pricing, it's essentially your core cost, usually called an FOB cost, and then you have a laid-in cost, which is the transport, and then you would have your 3-tier supply chain making money from each of their, from the OEMs, or the original chip manufacturers to the OEMs, from the OEMs to the wholesalers to retailer to you. There's stacking there when it comes to ability to get margin on a product and be able to sell it. What's going on right now is that when we don't have insight all the way down that supply chain if the core cost is getting bumped up and then somebody somewhere is making a lift is what it comes down to. I don't think that spread is all the way back to the original chip manufacturer. I think somewhere in there, because of supply and demand, there are an elevation. There is some tariff considerations right now with some of the GPUs and some of the PC hardware parts. I don't think that's made a change yet. On the tariff side, I think there are some just genuine taxing happening that's causing some of the lift in price. But bottom line, if you're buying a GPU, especially some of the new HX series GPUs that are coming out, I saw a post from videocards.net show that the new HX 330 series is now available for order, and it was pretty expensive, and it's effectively a 1660 Ti. It's about 26 mega hash at about 130 watts. It's probably less wattage than that. It's probably actually about 100 watts. But the prices on it are crazy. They're $1,000 for a GPU like that, or $850, something crazy, and that's just way overpriced. Like, I would say right now, anybody that's getting into this space, unless you can get it for near retail, I would just hold off. I would look for there will be some minor capitulation, especially if the price pulls back in the ecosystem. There's going to be people that are going to get shooken out. It's just like any other market. If it's people taking stake in a coin, or if it's taking stake in hardware, you're always going to have an ebb and flow of also people that are like, you know what, I don't have a tolerance for this. I thought I was going to make X. I'm going to now make X, and then they're going to sell their hardware. I would say do not pay extremely overpriced for GPUs. It's just not worth it. And this goes for gamers too. I mean, and that's as a person with GPUs that's bought GPUs recently, and we paid a little over retail price, but not 2x over retail, 3x over retail. Like, I would even tell a gamer, just wait for these. Like, people have stock and they're trying to sell them. Eventually, that cost of owning the stock or the risk of it, they will start to lower prices, and people will start to say, well, and hopefully the person that took in to try to scalp it didn't get too buried too far in that price. Otherwise, they're going to learn a really tough lesson on market dynamics, and that they bought something also at like a 2x and trying to sell it for a 3x. There's some danger in there. I think personally the effects that are going on right now in the market with the cryptocurrencies and the uncertainty that's coming up with like 1559, there's a lot of numbers we've all put out from the ecosystem about, is the miner extracted value going to make up for some of the fee burn? What is going to be the fee burn? As I've started peeling back some more of this data, that fee burn is going to be a lot higher, I think, than what's being anticipated. If there is a 6 or 7 ETH block right now, most of all that goes to the miner pool. They have an ability to game it a little bit to extract more value, but bottom line, the yields have been a lot higher on those days that there's a lot more activity. A lot of that, it looks to be where it's going to get, it's not going to be able to be extracted. I mean, no matter what they're saying, from what I'm seeing, it looks like we're going to have the 2 block reward plus maybe some minor tip that comes with that. But I'm planning for the worst on that, where we're at a relative block size of about 2.1 to 2.5 at the max. And that's the way the modeling from this point on, from at least what I'm going to capture, is going to be at. I'm going to assume a 2.5, no larger than that block reward size, and then hopefully be pleasantly surprised. That, I think, allows you to forecast a little different of what's going to happen with that. I'll show you kind of where I'm doing that in these scenarios here. This spreadsheet does have a link below. We have about 98 total viewers. You guys are probably going to get timed out on this. I'm trying to make this into a website amongst a whole bunch of other efforts that I've been doing with you guys to try to get this data put together. Write the Medium article that got sent out yesterday. There's a lot going on in my world right now to try to get this out to you guys, but I'm trying to make sure you guys have this available. I know it's limited and people have to take turns right now on this Google Sheet, but getting this put into a site where you guys can start really drilling down and start measuring stuff, I think, is critical for our industry to have a tool that allows us to calculate this. A lot of the bigger mining shops and stuff have their own versions of something like this, but this is something I think that is good for the just general GPU community to understand, or the GPU miner to understand kind of what are some of the effects on the largest market cap coin that you can mine right now, with being Ethereum, and what are those effects going to have to be. So I already have a couple of these scenarios typed in here to where you can see the key reference up here, and then the various scenarios. So if we end up going with a scenario where the price is flat but the volume is low, that will give the same kind of indicator that I'm talking to right now, where so right here, this flat price, low volume would be the expected rate if we're in July and the prices are around $1,700-$1,800 ETH price, but yet the volume switched down to just over 2. And what that effect is. And this is where a lot of the discussion is right now with the ETH team, that, hey, there's no existential risk, miners won't revolt, it's just you're going to have some yield kickback. That's going to get burned. The Ethereum network's going to get burned. The real effects of that is if our yield ended up dropping down to 2 and the price stayed the same on this particular rig. I think I have it selected as a modern rig design, 363 mega hash, 800 watts of power. This is like a 5,700 rig that's dialed in well, this is effectively what it would switch down to. Your monthly power would stay the same, and you would go from, like, in February making about $600 a month to making about $200 a month. So it's a pretty significant drop, but it's not upside down. Now that changes a whole bunch of stuff if you're calculating your expectation on the risk you're taking on buying the hardware at an elevated price. And this is where I'm trying to make sure that the one thing I think that all of the community members in the ecosystem that are providing any kind of information around crypto mining in general need to have that expectation set that these type of changes are coming. This isn't like EIP 1559 is end. There's nothing stopping it right now. There is some consternation between the pools that have went out against it, and how is that going to reflect, when EIP 1559 goes into effect? Are the pools nodes going to accept that? There's still no real statement out there if the pools are going to, try to fight it. This is me personally talking about it. I don't think anybody at the end of the day is going to stop it. I think there's a lot of effort that would be, it creates a disaster for everybody if there's a fork. Mainly because of there's a lot of content that out there that show, if you have a hard fork, and let's say you had a lot of development and people wanting to keep a mining proof of work fork, you would have this immediate deletion of value when it comes to like USDC. A lot of the stable coins that are tethered to the stablecoin value, which are the other sides of like the DeFi market pairs. And if you have a duplication of those, essentially those networks are going to honor one of them. So it's not going to allow a duplication on like a stable coin because there's no money backing that. So it creates this very, I would call it an unforkable event that's been talked about. There's some folks actually talking to this in detail, which create a whole mess of things. So I think it ultimately comes down to, if everybody follows the action, then what happens when it comes to processing blocks? And that, I think, is still up for debate on how the mining pools, which, mind you, when Ethereum developers and people that are opponents of proof of work mining in general, they consider all mining as like part and parcel of each other. So you got pools where all the mining is pointed to these various pools, which are like proxies to the network. Those proxies really control a lot of the fate of what happens when it comes to that block creation piece and the setting the gas rates and all of that. The change to that fee structure will now have this conflicting behavior that the pools are going to have to figure out how to deal with. If they're going to, is there this competition that's going to go when it comes to mining empty blocks and only including blocks that have minor tips? Because naturally that activity of mining is, an incentive-driven system. So if one pool starts to behave like that, or the other pool is going to behave like that, I think there's a lot of consternation that's still going to go on there. And, when you're dealing with money and finance and people's investments and all kinds of, there's investments on the mining side, there's investments in people that took positions in ETH, there's proof of stake folks that are involved. There's a lot of tug of war going on, as it were, in the space. And from back to just a general person that's using their hardware to mine and exchange a little bit of power and ops costs to be part of this ecosystem, the thing you have to be aware of is that consternation may result in a couple different effects. There's going to be an actual physical effect on the amount of yield that you're going to get, because there's going to, part of the mechanisms to burn some of that. So that is going to be a step down. There, nowhere in this does it really go up, unless for whatever reason users are going to be paying higher fees now to the tip side of it, and now it just makes a much worse user experience. But circumstantially, miners now process transactions, because I don't think that helps anything. I think it's a worse environment, and something with ETH that is predicated on usability. The features that come with ETH, that's part of the risk, is like we should be able to use ETH at low fee, and then the block reward is the subsidy that ensures the security architecture, right? This was never really supposed to be a fee-driven system. It's just the circumstances of the block reward plus fee is being part of that calculation that incentivizes a proof of work network. ETH became a victim of its own circumstances of having the success of the volume, and now it's created this kind of unbalance where the fees are now driving a lot of the increased force projection onto supporting the proof of work. It's a very unsettling set of circumstances, because no matter what, some group's going to get de-enfranchised or disenfranchised from it. And that, from outside looking in, if you are not mining yet, that's something to be aware of. And I want to make sure people are understanding that. My mic is clipping, somebody says. Is it too high? Here, I'll bring it down. Sorry about that, guys, if it was too harsh. But I think that's a critical thing to understand. So setting expectations is always important in anything you do. So I don't know if anybody can actually hit these drop downs. I've had different people say that some of them can't, some of them can. The drop downs should change the state of this thing. But like, if you were looking at these different drop downs here, if you guys can't use these drop downs, let me know, and we'll see if we can fix that. But this allows you to kind of look through different impacts. Like if you have a single card, hashing right now, what's it get for you, and what's going to happen with EIP 1559 in that. Somebody said, why not Twitch? When I went live here at this desk, I didn't have Twitch logged in. So again, you have the fee change with Ethereum. You have the balance in question. Is this going to upset the balance to create a pullback in price? So you have price and volume. You have volume absolutely affected. You have price unknownly affected, and price could go up too. There's these situations where this behavior or this change will cause a spike in Ethereum's price. The reason why I think that that's going to be subdued is because nothing here fixes any fee cost. That there is a more predictable fee behavior that will come out of this once the wallets and the technology stack is updated to take advantage of 1559. And maybe some of the wallets are going to be ready for that. Part of the whole point of having it on a test net is that the folks that are building secondary services for this, wallet makers, can actually start to tune and be prepared on day one of the launch to production that they'll be ready for. And like, you could download a new Edge wallet or download a new Access wallet and have a better predictable fee situation that may promote some usage, which will have this inverse effect or this direct effect where there might be more people wanting more ETH. Part of the no doubt bot infrastructure that's going to be out there, both on Twitter and just from a shared information standpoint. And I've said this from the beginning, it pays Ethereum investors to take the time to capture all the fees that are burned, and I don't want to say glorify that, but to just show the effect of what the fee burn is doing to the network from a supply standpoint. So if there's a bot that's on Twitter that you're following that's showing you, hey, today we burned $9 million in fees out of the $13 million in ETH that was minted, so then it's showing a delta of only 4 million or something to that effect. That does have it's more than just cool information. It's actually showing a potential of burn. there's probably a whole bunch of other calculus we can get into if that's a good thing on certain things, like because some of that behavior, a lot of the decision making around this is around the concept that burning it versus allowing it to be used in the ecosystem is a good thing. So it's taken the effect that miners are selling everything, and we all know that that's not the case. I mean, I know everybody that I know in my circle does not sell 100% of their ETH. I mean, there's been a few people that have been disenchanted by all this activity and are taking a position of like, I'm just moving all my ETH into another token because there's a brand awareness or brand disenchantment. So then they're coming out of the brand totally. But a majority of when you're not so close to your ops cost and you have a lot of lift, most folks hedge that for the long-term potential. So, or they redeploy that capital into the ecosystem. So by burning it, your only premise is that you're reducing supply potentially. You're taking away that investment that can come back into the ecosystem. And I've not heard any, discussion of the calculus on that. And it's hard to see unless you knew all of the various miners. I mean, it's a very individual decision making, but you would have to see how do they deploy their capital. And is part of that hedge back in more equipment? Is that part of that what's helping fuel DeFi? Bottom line, if you're burning it, it's just taken out of supply. So you're losing that weight, as it were, to forward deploy that into some other way. And I don't know if that's good or bad. I mean, that's a philosophical discussion as much as it is a mechanical and math problem. So there is that, and that's never really talked about. But, to digress back to the main point of this video on ETH, if getting in, don't overpay for GPUs. And, if you're at the top right now and you're like, maybe it's a good time to exit, I don't fault you for that. You should have, you're looking at the same numbers I am. These are forecasted numbers. They're not actuals. We'll see the real effect of it, but we do know that base fee burn is going to have an impact. If that impact is going to be non-tenable for you, and this is, again, just a view on ETH. There's a whole bunch of other, I'll come back over here to GPU analysis here. This breakdown here takes like a typical 3080 and its output, and then predicated on the total network hash rate. So I came out there and I looked up all these different network hash rates as of yesterday. And I've done the math essentially to calculate. Oh, it didn't copy my actual formulas. I need to go in there and put my formulas back in. So there's a formula that calculates off of this measurement to figure out if something was mining at 91 mega hash, which we know this is about 99. So I'm being conservative on some of the numbers here. If it's 91 mega hash on this, but it's on, Z hash right here, it's 134 hashes, then what's the algebra of equivalency to see how much total force projection could come onto ETH? And that's really where this number came from. So we could extrapolate how much extra potential is there if all of the GPUs were on one particular network. And that was the whole point of this. But what it allows us to show is that with the sea rising all boats, with Bitcoin's price being up relative to what the Satoshi value of a particular coin is, if that Satoshi value stays the same as Bitcoin goes up, it rises the USD value of that coin. Because the way the market works, by and large, is not where you have an immediate dump of that coin. It'll set at its Satoshi level on an order book, and as Bitcoin starts to go up, it starts to pull up that USD value of that coin. There are a lot of automated market makers now trying to correct that or see what the floors are of specific coins. And so as Bitcoin starts to rise, there's a natural start to dump because that USD value is higher on a particular token. But the bottom line is looking at what makes more sense for you and in profit, for when you're looking at what can you get back out of your GPU or your investment. Um, and I would say pay attention to a lot of the other tokens just to see they're a lot more speculative. Um, you look into the different programs when people are asking me all the time, hey, what about this token? What about this token? I track about 5 main tokens and their development. It's a lot to understand where each of the other ones are coming from, like if you really start to peel it back. But it doesn't mean that you shouldn't investigate it yourself. And that's what's good about having a lot of other participants that are covering a lot of different projects, is you have a good spread of knowledge being researched and communicated to everybody. So it's good to have a good diversity on your kind of viewing when it comes to what cryptos to mine and be part of, and what's your hash rate work for various tokens and coins. Like I said, it looks like a few people could probably get into this right now. We're at 99 total viewers. You keep the link. You guys know how to get to this. I'm going to take some questions. Hopefully I covered most of the background of the mining piece of it. I do want to answer some of your guys' questions. I always go back and look at the chat to see if I missed anything that was critical that we needed to have a discussion on. Anybody have GPUs for sale? So Daniel's already kind of front running the ready for sell piece here. I've been looking at Cortex. Have you been tracking that one? No, I did put it on this list, I believe. Do we have Cortex on here? No, we have Conflux. Cortex's network size didn't look very big right now, so I did not include it on this. Did you see Pellets HX30 listed for $720, only capable of 26 mega hash? Yes, I did. I referred to that earlier in the video. So videocards.net, I think, has, let's see here. It's the make sure I spelled this right. HX30 video cards. Let's Google that. Here we go. Well, they said this one. There was another thread here. Not that one. Let's see if they have. It should be on the front page of their site, I think, the articles. There, no. Here we go. It's on the front page of their site here. So here's what was brought up as a question. $721. This is a horrible price. This card should be about $300 at the most. $330 is what the retail of that type of card would be. Maybe $349 at the most is what that card should be. So it's about double its current price. What do you think about the new A11 miner? If it's 2.6 gigahash, that's pretty epic. But they're going to be extremely hard to get, and they're extremely overpriced. They're like $26,000 right now. And if Ethereum does spin up its proof of stake transition and can get that checked in, validated, tested within the next year, I think you would be with 1559 going in, and there's let's say it drops to 2.1 per block yield. I mean, the price would have to be in the 3,000s to potentially make your ROI back on that. And the ASIC's a different play for something like Ethereum, because Ethereum is going to go to proof of stake. This is like a known fact. So that hardware is going to truly be useless unless somebody else spins up an Ethash chain that has a prominent value, because if all those ASICs go to an Ethash chain that doesn't have a huge amount of liquidity, it's just going to bury the network pretty quick. So Ubiq hash for Ubiq has moved to a different algorithm. ETC hash is a different algorithm than ETH hash. So all the major ones that used to have that hash have switched their algorithm anyway. So that's a bigger issue. Let's see if more folks have some questions here. Let me scroll up here. Would be adverse. is it worth investing money in mining after the mining hype? Traditionally speaking, when mining is at its lowest profitability and rigs are at their lowest, it's been traditionally a good time to buy. So if you can get rigs well under cost, picking up hardware during that time, you are just taking a deflated risk on the hardware with the premise that you'll be able to get good yields from cryptos that don't have a huge amount of price discovery at the point in time, and the networks contract traditionally in crypto. So like the network hash rate will contract. ETH's hash rate contracted all the way down to 130 terahash, up from its high of almost 300 terahash. It more than halved its amount of terahash on there. Which what that meant to you is that you got more than twice the yield for your mining effort during that time. Other networks are the same way. So if mining in general takes a step back, if all the coins prices come down, for whatever reason, you're going to have a lot of capitulation in the mining industry. You'll be able to pick up a lot of that hardware a lot cheaper. Is a 3070 worth $1,500 USD for mining? No, a 3070 isn't worth $1,500 for anything. I would not pay that much money for a 3070. 3070s are supposed to be like $600. That's more than double. I would not do that. Can you explain spec mining means? Spec mining means that you're doing a speculative mining, meaning you have a rig and you've pointed it to a crypto network that doesn't have a huge amount of hash value to it right now, to where your yields are going to be higher. If I go to mining pool stats, this is a good site to understand these different algorithms. This is sorted by algorithms. If you do algorithms various, not for that one. Let's do for GPU mining. So here, give you an example. So Vertcoin would be something like it has 3.2 gigahash. So it doesn't have a huge network out there. Let's do Ubik. You have Ubik has the same. It's a different than Fhash, but it has essentially the same principles. So you're 1-to-1 on your hash rate. Actually, you get a little faster on Ubik, but like if your card does 50 mega hash, it's going to do probably 52 on Ubik. And you can start to see that on Ubik, its inflation rate, all of that, you're going to have a higher yield. So you'd be spec mining something like Ubik. Its values at like 30 cents or something. Where's the price in the 34 cents? It had a peak high in 2017 of $6. It's implemented it's effectively forked the Uniswap protocol, so it has actually an entire ecosystem. I'll show you. I'm making a video. Is it on Brave? Can't remember which. I think it may be this one. So I'm making a video here soon on. I don't remember if I did it here or not. On this machine, I might be a different machine, but let's see. Brave. Nope. Not now. Brave. Mozilla. Yeah, here we go. Mozilla. So I'll give you an idea of this is like what spec mining is. So I have a couple rigs pointed to Ubik, and Ubik has a thing called Sparrow. We'll unlock that. So in this spec mining thing, I have like 23 Ubik in here. It's about $8 of Ubik in here, and you have these different networks where they had taken the Uniswap protocol, and they created a thing where you can create liquidity pools against like Etcher and Ubik, which I have 3,100 Ubik in there, and you can harvest TGE1 tokens, which right now are not worth a lot, and you can see doing the same thing as like Uniswap, where you come in here and hit confirm, and now I'm harvesting these tokens. There's different strategies on inflating a token or creating a token. Some networks are proof of work, and you earn it through the block reward of mining. And that's the way a token inflates. That's the way Bitcoin inflates. When, up to its total of 21 million. The way Ethereum started with a pre-sell and a pre-mine. So it started with about 70 or so million coins that were pre-mined and sold to investors. And then from the 70 million to what were like 120 million coins, now that has been mined. So it took a two-part strategy on getting the token out into the space. Other tokens or other markets, such as like Uniswap, did an airdrop. So if you had an interaction with a particular chain and its function, they looked at everybody that had touched it with their address, and they don't have to know you from Adam, but they know that this address had an interaction with a network, and then they dropped their distribution on top of you. So then it kind of incentivize you to participate in the network, because they're like, hey, we're giving you 400 tokens. There's different ways that coins go about this. This is the same thing with like TGE1S. Is it's taking the fact that you're staking Ether and Ubik, and based on that stake, the payout, it's inflating through this harvesting mechanism, right? And it's just a different strategy. These are all different strategies on what's the best strategy to not come out like something like XRP, where effectively you made the entire supply in a vacuum and then you issued out. You're a security by all intents and purposes there. If you just make a token and start selling it to people, you're effectively creating a security. So there's different methodologies to it, but this is an example of like where you can go with how deep you can go down into spec mining, where you can point a rig to something like Ubik. It's not a huge amount of revenue and value right now. You're speculating that it may be at some point, because they're building infrastructures at low cost fees comparable to something like ETH, right? So they're competing in the same space, but they're trying to do the same thing. They've taken some of the built-in infrastructure to where you can go out there and see stuff. I think we can come in here with balances. I have 723 TGE in this particular thing. If I go to let's do it's not Sparrow. It's Shinobi Ubik. I may be misspelling this. Here we go. So if I come to this is the Shinobi setup here. So this allows me to connect in, and you can see, let's see here. There should be a different, that's the swap. But you can see it's the same, effectively the same setup as Uniswap. But Shinobi is like Uniswap for Ubik. So there are other networks doing this kind of stuff, and I want to make sure, that's what, trying to answer your question from I'm fixing it. All right. There we go. Should be fixed now. I still got audio. There you go. You know what that was? That was the RTX voice crashing. So +1 to NVIDIA. Yeah, for some reason the RTX voice app crashed, and it took out my input. Where you said something about Shinobi and then it cut out. Oh my God, really? My dudes. All right, hold on. So do we lose Shinobi at this point? Audio equals 300 plus likes. Plus -1 to NVIDIA. So Shinobi is Ubik's version of Uniswap. So if you had there's a handful of pairs out there, but if you had Etcher as part of the airdrop, as part of owning Ubik, you could lock those up as liquidity pairs. I mean, so this was the discussion on if you were spec mining, what spec mining mean? Spec mining means that you could take an option into something like Ubik, and then with that Ubik, it has depth of field when it comes to, it also has a DeFi of its own. It's mapping effectively to the same kind of structure as a Uniswap, and then you could start to lock up other pairs on there. The eventuality of all of this is a linkage to having, you know, if we start seeing linkages through like the Atom on Cosmos network, where you have interoperability between blockchains, you have this ability to go from a decentralized way out of something like Ubik to Uniswap, Uniswap to ETH back into Ubik, and you have this liquidity pool kind of structure and design set up to where it's all everybody's providing that has the token that either mines it if you're a miner, or if you've bought it and you're just a purchasing participant, you have that opportunity to be part of it. So part of spec mining is taking your hardware and pointing it to these networks that are trying to innovate and trying to bring value proposition to potential investors or potential people that are going to use these other utility tokens. So I was using the Ubik as one because Ubik's actually taken the time for this. It's really actually surprised me that ETC hasn't done this yet, and I haven't looked into it deeply enough to find out why they haven't really participated. Probably because of the various double spin attacks that happen on it, that people would be very risky of what would happen in a double spin world with something like that. But now that they have mess in there, I think they could start to investigate it. Shaggy, good thing to know that my RX 6900 has better 31 and 32 performance than the 3080, and not just mining with. Just got into mining with 10 1660 supers at a decent price. Well, good job on that cheaper price for the 1660s. The 6900 XT, and I believe this is going to be the case for the 6700 XT that comes out tomorrow, is the ETH performance or ETH hash performance, memory hard performance on it's going to be lower than expected because it's 192 memory bandwidth bit versus the 256. So the people that are not tracking the 6700 XT coming out is effectively the RDNA 2 version of the 5700, with the one core caveat that it has a faster core speed, but it has a smaller bus bandwidth down to 192-bit versus the 256-bit. And that's the reason why your ETH hash performance is going to be lower on a card like that, which doesn't really impact the gaming all that much, maybe 5%. With a smaller bus bandwidth like that, but it has 12 gigs of memory for the 1440 performance. So from like a gamer standpoint, I think it's going to be a good card, especially if you're in that 1080p 1440 realm. It's going to be a really good solution at a pretty decent price. So, But I mean, a lot of hate's coming out on it because the 3060 Ti is cheaper in theory, and I think there's going to be some discussion on that. But I'm trying to get one tomorrow. I'm going to be there pretty early to try to pick up a 6700. I'm going to actually put it into a gaming machine, a 5600 Ryzen gaming machine, but I will do obviously testing on it. And where I was going with that is that the core performance on the 6900, the 6800, and now soon to be the 6700, I think is going to be very competitive on the NVIDIA standpoint, the same way it's competitive on the gaming side, to where the 6900 XT goes toe-to-toe in a lot of ways on the rasterization side with the 3090. I mean, they're trading blows and some stuff with the 3090 pulling ahead. And obviously all the RTX lines pulling ahead when it comes to ray tracing stuff that have to do with video games, not so much cryptocurrency. But the currencies that are related to core-related activities, it's going toe-to-toe with the best NVIDIA cards out there. So as we start to move away from something like ETH in the longer term here, when ETH goes to proof of stake, if you have core-heavy algorithms, not memory-heavy algorithms, the pivot's going to switch to where I think AMD 6000 series and the future cards that are really emphasizing high core speed may come into more of an advantage. So don't discount those core-heavy algorithms. I'm gonna have to do some timestamps on this video for sure, especially with that kind of gap in the audio. Is it a good time to buy GPUs? Perhaps it's a better time to invest in my favorite altcoins instead. Well, I mean, this is obviously going to never be direct financial advice. However, I can tell you what I'm doing. I'm not buying GPUs by volume right now for mining. They're just all too overpriced. It doesn't make sense to me, especially that we're going to have for sure yield decrease coming up. I mean, there's no mistake at all. Expectations set. Yield is going to go down. Mechanically, it's going to happen. Now, the question is the tips going to make up for that difference? Unknown. Is the price going to go up? Unknown. Both of those things are both calculated risk. But what I can plan for is what the known states are, and 1559 is going to go in. It's going to go in July. There's going to be a lot of animosity around what's going to happen with the pools and how are things going to get processed in that. And that is that by itself is grounds for take caution and that sort of thing. Let's go back to the mining model here. If you're rich, go buy the GPUs. I still wouldn't do it, my dude. Ron Watkins, like a 25, 30, 80s halfway between MSRP and scalped pricing. Yikes, my dude. Golden Wolf says, if I was in front of you at my Micro Center BBT, I would give you my place in line. No, dude, it's fair market. Fair market. If I show up and I'm behind you, my dude. You've earned that spot. I do appreciate the gesture, though. Mike Howes, can you explain in layman term what MEV is? MEV is miner extracted value. There's about 4 different ways to have it done, and this was covered in if you look up the video with Micah, so just look up MICAH and BitsBeTrippin, you'll find that video, and he explains about the 4 different methods. But at the end of the day, it's the ability for a mining pool to review essentially if they want a block in an instant, they can review the transactions they're going to include in that block. And I'm going to give you one example of one of the things they can do. They can front run any activity that they're about to post as part of that block. So if they see a very lucrative trade about to occur that's going to result in a higher, a better situation for them, they have the opportunity to front run that transaction, do exactly what the user was trying to do, pay a higher gas fee, and overstep that transaction and include it as part of the block versus and kick the other person's transaction out. It's a very questionably unethical thing to do, but there are other quote unquote ethical, or I'd call it just questionable, but probably not a question on ethics. It's just first mover advantage opportunity where the miner pool becomes kind of the automatic market maker and can take advantage of the things that it sees in the mempool that it's won the block for, that it can reorder, sort things to its advantage and extract more value in doing so. It ultimately has a byproduct of potentially disincentivizing that activity on a network that's doing it. So the ultimate question is are other networks going to be able to start to participate in DeFi at the same caliber as Ethereum, and are they going to have some level of protection when it comes to that front running activity, to where maybe it's like shielded, some of that it gets nested into like a shielded side chain and can't be reviewed in the time that a block needs to get posted. There's some kind of mechanism that's probably going to incentivize market participants to go to that type of chain than have one that's always going to get front ran by the mining participants. A key factor here, though, is that behavior does not change with proof of stake as it currently sits. So if ETH moves ahead, accelerates the schedule, and we're within a year of moving to proof of stake without some serious layer 2 options available, then you have a situation where proof of stake nodes, the validation nodes, could technically start to inhibit that same kind of behavior, to where they're now doing the same exact thing that mining pools can do. So it's not like proof of stake is going to change that behavior. And it gets a little more complicated with validation on proof of stake, because technically, if I understand the current reference architecture that's out there to be understood, is that all block producers for an entire epoch will as it goes through the random number of who's going to be the block validators, those become known at the start of an epoch. So theoretically, you can pre-game in a lot more effectively as a proof of stake person than you could even in a proof of work, because proof of work, we don't know who's going to win. Every block is we're mining all the same information at different difficulty levels to try to find the answer for the pool that we're on. So it is unknown which block is going to get won by what pool. It's just statistically we can figure out that if you have 30% of the hash rate, you're probably going to get 30 blocks out of 100 type of thing. And then based on how many more you have versus how many less you have of that is your pool luck. It's an interesting environment as it switches away from proof of work on how that's going to be handled. But that's MEV in a nutshell for you. Just looking for something that can earn passive income and is scalable. I mean, there's a lot of different tokens that allow that to happen. I mean, you could take a position into DAI, you could take a position into Cardano. I know has staking in it. I'm learning more about Cardano. I still have a ways to go on feeling confident enough to talk technically on some of their post Shelley updates, but there's you can take, it's all about risk profiling. So people are like, why would you ever get into mining versus just owning the token? Well, because the token can come down at any moment's notice, or a major issue can happen, and in a major notice, you know, like you take risk in anything that you own wholesale. And then you have, like, mining has always been a hedge. And so I've always presented it since 2013 with you guys on YouTube, as mining has always been a hedge, right? You are taking a position in a physical asset. You are enhancing the security of a network. When you're mining for it, you're providing a service, and for that service, you're compensated in a token. That token then you can force deploy into its feature sets, or you can hodl it. You can do other stuff with it. There's various ways to participate in this space, and it's just mining has always been a hedge. It's And that's why I've always liked it. And I like the barrier to entry to mining. Like that's the other part that doesn't get captured here, is the barrier to entry in mining is a flash to bang pretty quick. I mean, somebody can get lost on the internet. Well, I said this in my Medium post. You could get lost on the internet one day and just discover mining and be like, what the hell is this? And then figure out like you have a decent GPU in your computer. And then you're like, well, let me download this thing, and I click this button, and I go out and get a mining wallet. I mean, I've heard of stories of, people have given to me like, man, I found your video, I watched 2 of them, I went on to this other thing, I downloaded, this one-click miner thing, if it was NiceHash or something to that effect, and then they were mining, and then they let it go overnight, and then they woke up the next morning and they had cryptocurrency, and they're just like, I don't understand. Why does this work? Why is this? And they get down that rabbit hole that ends up spending them from 1 GPU to 10 GPUs to having, an entire garage full of GPUs, right? Because they start to understand that you're a service provider and you're getting a token. And then you start to get disenchanted when like the networks start, like you hear all this negative connotation and you're like, why are we hated? Like, what's the point here? And it's all a disconnect on understanding the proof of work and why participants would hedge with hardware versus going all in on the token. And it's the how much palette do you have on risk, and a lot of people that mine like to hedge that risk on hardware that you could resell, and then on networks that are not going anywhere with regards to they're not trying to kick off proof of work, then they usually end up with as FPGAs or ASIC networks. So if their full long term is they have to make a concerted effort to keep ASICs off of it if that's the goal of that network. So like, Ravencoin, which is not going to get rid of proof of work, they have no desire, the community has no desire to get rid of proof of work. It's always going to be proof of work. So it's always going to be challenging the ecosystem to find the most efficient hardware with taping out the most, cheapest way to do it. It's always going to be this like constant arms race to figure out on proof of work. That's why Bitcoin went from CPU to GPUs within a year, and from GPUs to FPGAs and the first series of ASICs after year 2. You started first having the taping out of that, and then coming on to year 3, it was pretty much all year 3 into year 4. You pretty much had all ASICs. Litecoin was the same way. Script started that way, and within a year, it was already the first sets of ASICs coming out. I mined Feathercoin back in those days. I mined Doge back in those days, and then immediately Doge was able to be mined on GPUs for probably about 4 months, and then ASICs were already out for it. I mean, it was just they were already being produced for Litecoin, but then it kind of came that way. So again, it's just a hedge. Can you share the Discord link for the BBT server? The latest link below does not get you guys there. I need to update that. All right, guys, we've been live for about an hour. I'm going to wrap this one up. Please put your comments. If I did not cover your comments below, put them below. I'm working through, like everybody else is right now, on making sure that the bots, if you don't see a comment from the highlight it with the checkbox, that's BitsBeTrippin from me. It is probably a scam trying to get you on WhatsApp and try to take your money. So don't do that. Doge is for triggering people. We'll have a discussion about Doge sometime. But hopefully this has been informative. I'm going to get back to, I'm going to another meeting here soon, and I want to make sure that you guys had some of this information, some of the sources, and just don't overpay for GPUs. Hopefully tomorrow we'll have a good video on the 6700, provided I can get one, and we'll get back into just, looking at that. And I love new GPUs. I love being able to go through new GPUs, so hopefully we can get that. And if I can get a sample of the HX series, I will pick them up. I am not paying $721 for it. It ain't happening. So if somebody in this chat finds one, I will happily do a review for it. I'll sign it for you. I'll give you a total props on it if you can get one. But right now, it's just, I'm not going to pay into a 2.5 times cost on it. That's just ridiculous. But I would like to test out the HX series just to see from what its full capabilities are. All right, my dudes, hit that like button. It helps the algorithm share this to other people, and I will catch you guys as early as tomorrow if I have that 6,700.